Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm lucky enough to be joined by Nick Bohnsack, president and head of portfolio strategy at the firm. Nick, how are you doing today?
I'm doing really well, my friends. Good to see you. Nice to have me back.
Yeah, appreciate the time. A lot to talk about, but I think interestingly, with markets, hovering around all-time highs, the economy doing pretty well. It does seem that the focus is shifting to more of the politics and the election year of it all. I wondered if you had a quick take on the election year and how you guys think about investing in election years before getting into the meat of what actually matters for investors right now.
Yeah, for sure. And I think the observation is well put. The market has been doing well. I think when we run around, there don't really seem to be a lot of bears out there, or bears that are invested towards that outcome. And so at the end of the day, when things are generally going well, which is how we take stock of our portfolios up and to the right, so to speak, people's minds tend to gravitate to more macro issues. We're very early in the election cycle, although it does seem at times to be perpetual. I think it's obvious from some of the results, if you're looking strictly at the nominating processes for both parties, that President Biden, former President Trump will be the major party nominees. Absent the exogenous, which need not be spoken at great length here, we would anticipate a Biden-Trump matchup as we move into the fall. That really only leaves the question of who Trump would pick as his VP. He's provided a short list, as he did with Supreme Court nominees the last go around, or prior to, I guess, his first run in office. So a lot of noise is going to come out of politics. What we think is most important from the policy column, from the policy channel, if you will the government, the Biden administration in this case, continue to grease the skids with additional provision of fiscal policy, whether that be funding the government's obligations at the short end of the bond market, or other distributions and transfer payments. All of that is Republican or Democratic alike administrations is towards finding themselves into a second term. So we would expect a lot of noise around that. We certainly have government shutdowns and other little pockets of dislocation coming to us, but a lot of noise for much ado about nothing until we get out to the fall, which I think really is the opening to talk about some of the fundamental considerations that investors should also be keeping their eyes on.
Right. And you've mentioned before, kind of the building blocks of equity market returns and how you all think about the market, starts with earnings and interest rates. And, I'm curious how you're seeing those two areas. The Fed has been in focus for the better part of a couple of years because of inflation. They remain in focus in 2024. We're putting a bow on an earnings season here. How are you seeing the market through the lens of those two items?
Yeah, spot on, Ross. I mean, listen to me. The Fed is really, perhaps unfortunately so, but to your point, it's been a couple of years now, so it's sort of just the state of affairs, has really been at the center of what the stock market is going to do, largely because of their comments on the future direction of policy, of interest rate policy. We came into this year and the market was bullish as it remains, but very much anticipating interest rate cuts to begin as soon as this month, March. And it now looks that would be delayed on the combination of slightly higher than comfortable inflation data, slightly weaker than comfortable growth data, but enough cover for the Fed to remain, less accommodative than perhaps they need to be. I think the transition mechanism, though, that we should be mindful of, and you mentioned earnings in the question, really is what are the lagged effects of the tighter policy regime that we've been operating in now for almost 2 years in full, but certainly almost a full year since their last hike. And I do think you're starting to see some cracks, particularly down cap, where there's more exposure to the variability of interest rates in general for corporate operators. Certainly small caps have not participated in the super strong earnings move that has generally been described in the media as having taken place over the last couple of quarters. So where does that, in a short sentence, where does that end your question? I think, the Fed is still inclined to cut, but that's being pushed further and further back into this year and maybe even rolling in to next year. They are using the provision of fiscal policy to help them keep the economy buoyant. And you are starting to see some fracture in the earnings landscape. The big guys continue to do pretty well. They're cash cows. They're generating. as you suspect they may be, but you can even see them starting to nip and tuck at some of the cost profile. So all in, it's a market that doesn't give you a lot of pause, a lot of cause for concern, but it's one where the macro fabric, does provide some things that we want to continue to be, focused on, even to a slightly degree nervous about.
Yeah, and as you mentioned, and let's bring it full circle to end here, you mentioned at a time where there's very few bears, in your meetings, our clients in the news, you just don't hear very many bears right now. Is sentiment a risk here, at least in the near term?
I think when sentiment gets to an extreme, it is something that you have to begin to think of as becoming a risk. And we're approaching those levels. You and I both speak with a lot of our Baird clients. I have some opportunity, as I know you do, to chat with others, outside of our program. And there are, as you say, not a lot of bears out and among us as investors. So at the end of the day, when bullishness is, to borrow a phrase, running rampant, and you see very defensive corners of the market, bouncing around the bottom, if you will, and not really making any decided moves to the upside. I actually think, an investor and advisors who are thinking about their long-term financial plan, I think it behooves them, even if they're long equities, even if they're slightly overweighted to equities, to put a few sort of defensive pieces of insurance, lowercase I, in the portfolio, so that if something comes, an exogenous event takes place, or there's something that surprises us, which of course we're all familiar with. Unfortunately, the portfolio can be only slightly inoculated from that. You don't have all your eggs, as they say, in one basket.
I think it's great advice, a great way to end our conversation today. So, Nick, thanks so much for the time as always, and hope to talk to you again soon.
Indeed, my friend, looking forward to it.